Welcome to this week's podcast, brought to you by the Good Money Guide and our sponsors Pepperstone, who are a multi-regulated CFD broker providing trading services in forex, stocks and commodities in multiple destinations. I'm Michael Hewson, and joining me again is Pepperstone Senior Market Strategist Michael Brown. Good morning, Michael. It's only been, about 48 hours since I saw you last.
Well, very good morning to you, Matt. I was going to say we did see each other on Wednesday, and a very good event that the Good Money Guide and Richard Berry put on with their London summit, and good to see you and everyone else who was there.
Yeah, I've never really seen Richard so nervous, particularly with the FCA being there, and I think.
Well, if the FCA are in the room and you've got a microphone in your hand, I think he's got every right to be nervous, mate.
I think I controlled myself very well.
You did.
Even if I did say so myself. Anyway,
shall we cover ourselves with a risk warning before we get in trouble?
before we get into that, it's been another packed week, I think, for macro.
Yeah.
Good and bad news for the UK in equal measure. On the one hand, we had a pledge from the US tech giants to spend billions of dollars on tech infrastructure here in the UK. It was front page on City AM. So that was good news. I waved that about in the room on the panel on Monday. But if you actually turned inside on the page, there was bad news, because the latest Bank of America fund manager survey showed that outflows from UK markets were running at the highest level since 2004. So, a little bit of a cloud there on top of the silver lining.
Yes.
But yeah, before we get into that, Let's do the risk warning. Otherwise, I could be getting a tap on the shoulder.
We don't want that.
Not only from the FCA, but also from your compliance department. So, Anyway, the information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any readers, viewers, or listeners of this content to seek their own advice. Spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 73.7% of retail investor accounts lose money when trading spread bets and CFDs with this provider. So, US markets continue to make fresh record highs in the wake of this week's Fed rate cut. Shift towards a slightly more dovish stance, so we're going to talk about that. Encouraging the prospect of more rate cuts this year. Not really sure how many. Bank of England, Bank of Japan holding rates steady. So we will talk about that. UK economic data. Some good news, some not so good news. We'll talk about the inflation numbers. We'll talk about unemployment. We'll talk about retail sales, if you can believe those numbers. And we can talk about the elephant in the room, public sector borrowing. Moving on from that, we'll look at the retail sector, Next's results, and there was a warning in Next results as well, certainly in terms of the employment component, and I will talk about that a little bit. I'll expand upon that, because within their balance sheet or their profit and loss statement were some very concerning trends regarding employment trends. So we've got that to talk about. We've got FedEx results. Up 5.5% in the post-market in the wake of their earnings last night. They've certainly delivered. Yes, I'm going to say it. And Darden Restaurants, Olive Garden results, large dose of indigestion after some what I would call some fairly decent numbers. So
I think we need to get you a swear jar for these.
The puns are coming thick and fast, and we'll look at the week ahead. And it's a fairly light docket next week. We've really only got flash PMIs, US personal spending, US PCE data. Obviously, we can expand upon that in the context of the Fed discussion, as well as numbers from Kingfisher and JD Sports, as well as Raspberry Pi. So, quite a bit to get through, but certainly not as heavy in terms of docket as has been the case in previous weeks. So let's start with the Fed.
Yes.
The floor is yours, sir.
Oh, thank you very much. Were there any surprises from the Fed this week? Not in terms of the rate action itself, obviously that 25 basis point cut. Not really in terms of the vote either, with sounds weird to say Fed governor. He is now a Fed governor. Steve Moran, obviously Trump's puppet, voting in favour of a larger 50 basis point reduction. I think the big message for me from the FOMC this week, not so much from the press conference, which frankly I don't think Powell did a particularly good job at, but the statement and the dots. The message was very much, I think we're looking at a front loading of interest rate cuts. The Fed are looking to, well, they've penciled in their dots a median expectation that they'll cut rates twice more this year. There are only 2 meetings left this year, so it's almost nailed on now. We get a cut in October, we get a cut in December. The Fed have also very heavily tilted what we call their reaction function, basically what they care most about, towards the labour market. This is a Fed saying we want to step in, we want to support employment, we want to support economic growth, and we are going, the potential cost for that is we are going to potentially take longer to get back to our 2% inflation target. The way the Fed are weighing that is basically we think the risks of a spiral higher in unemployment are much greater than the risks of a spiral higher in inflation. And I think for asset markets, certainly for equity markets, that's a very, very potent mix to drive markets higher. You've got a much looser Fed. You've got already solid earnings and economic growth, which you now expect to accelerate, and a monetary backdrop which is going to become looser quicker than we thought. So no surprise that we saw all 4 of the major US benchmarks, the S&P, the NASDAQ, the Dow, and the Russell 2000, they all closed at a record high yesterday. And I think there's probably many more to come.
Yeah, I mean, in terms of inflation, are there concerns that perhaps inflation is going to be sticky? Because I think one of the most common refrains I heard when I was in the US was that budgets are tight, and that restaurants are implementing or introducing budget ranges or budget offerings in terms of their meals. Which suggests that consumers are certainly starting to feel the pinch when they go out to eat. We heard about them, in Denny's. We heard about it in the Olive Garden as well, that they were introducing these budget ranges for sort of hard pressed consumers at a fairly low rate, below $10 budget range.
Like a saver menu at McDonald's or whatever it might be. Yeah,
it's exactly like that. So when I look at producer prices in the US, they have slowed, but it's not really been reflected in the actual headline inflation numbers as it stands at the moment. So I think is there an acknowledgement of that inflation could remain sticky while not actually going that much higher?
Yeah, I think that's definitely a risk. I also don't think it's a particularly new risk. I was actually having this conversation with a client earlier in the week, I think it was yesterday, where I reckon probably for 3 or 4 years now, central banks have, for all intents and purposes, given up on the 2% inflation target. We went through the sort of pre-COVID period where every conversation was, is inflation ever going to get back to 2%, because it was too low at the time. Now we've got the opposite side of that, where inflation is effectively too high, and that 2% has become a floor as opposed to what it was previously in terms of being a ceiling. And I think there is a risk, and the big risk that's on my mind is that the Fed and Powell and all the policymakers are saying, tariffs are going to be a one-time shift in the price level. That's their base case now. And that's correct. That is the way that tariffs should work if you look at the textbooks. The problem is these tariff rates are changing all the time. And new sectors are being added in and trade deals are being struck, which means some sectors are being taken out. So, yes, it is a one-time shift, but it's many one-time shifts in a row, which, funnily enough, becomes a trend quite quickly. So I do think the Fed are right to step in and try and help the labour market, but I do wonder whether there might be a bit of complacency beginning to creep in on the other side of the dual mandate. Yeah,
I mean, one of the things I took away from FedEx results last night was the fact that they estimate that the tariff effect is going to cost them around about $1 billion over the course of the next 12 months. So there is a factor at play in that. So I think, obviously Moran, no surprise that he voted for a 50 basis point cut, but interesting to note that he didn't take Bowman and Waller with him.
Yeah, I thought that was interesting as well, actually. They probably have both put themselves out the running for the top job now by not dissenting. But, I think, again, that shows, because you've got to remember, of course, for listeners who aren't aware, both Bowman and Waller dissented for a cut in July when they held the Fed funds rate steady. So I think that just suggests that, yes, they are willing to ease policy, but they want to do so carefully and, well, to coin the BOE's language, gradually and carefully, as opposed to just cutting rates in these larger moves, which, as Powell said at the press conference, are sort of reserved and kept in the back pocket for a time where you need to move quickly. The level of restriction is too loose or too tight, COVID, the inflation surge, etc. Not these kind of essentially insurance moves that the Fed are making now.
Yeah, I mean, I think that's a decent segue for us to start talking about the Bank of England. Your mention of it there.
Do we have to? Why did I bring that up?
we do, mate, sadly. But, for me, no surprises that the Bank of England voted to keep rates unchanged. You look at the underlying economic numbers this week, inflation, 3.8%, could well go a 4 in September this month when the numbers are released in October. Unemployment, 4.7%. Food inflation rose 5.1%. And again, it's a similar trend that we're seeing pretty much broadly as well in the US, even though food inflation there is only 3.1%. Here it's 5.1%. So the Bank of England's hands are tied, aren't they?
Well, they are for the time being. I think, to be honest, I'm not entirely sure we've actually learnt much new about the UK economy this week. As you say, inflation is high and it's going to continue moving in the wrong direction, away from that target. There was a little bit of relief if you look into some of the underlying parts of that inflation release. So services inflation came in at 4.7%. That was below where the bank had expected it to be. Core inflation down to 3.6%. So some silver linings there, but not enough for the Bank of England to, claim victory on restoring price stability. Again, in terms of the labour market, unemployment's at its highest level since the middle of 2021. It's not getting any worse, but it's not getting any better either. And downside risks are obviously plentiful ahead of the budget on the 26th of November. So, yeah, I think it was very much a case of as you were from the bank this week. In terms of rates, at least, you've still got the two doves who are in favour of a 25 bip cut, Taylor and Dingra. You're still in a situation where the bank have an easing bias with that gradual and careful guidance. And you're still in a situation where when Governor Bailey wants to make a cut, he can. There are going to be enough members on the MPC to force that majority decision. The real area of interest from the bank this week came in terms of the balance sheet, which I'm sure we can get onto when we talk about public finances.
Well, I was going to talk about that because Catherine Mann stood out a little bit in terms of asking for a slightly more aggressive tone down of the QT process. I think she argued that they should be only reducing it by 62 billion. Am I correct in that number?
Yeah, you're right. Which actually, and I don't remember the last time I've said this about Catherine Mann, is actually a sensible and logical take. So the way that the BOE's balance sheet runoff works is you've got a proportion of it which is just gilts as they mature, they roll off the balance sheet, no gilts are bought to replace them. And over the next 12 months from the start of October, there will be £49 billion worth of gilts that mature and just roll off the balance sheet. So what Catherine Mann did was basically go, well, that's going to happen anyway. Last year we sold 13.13 billion. This year, let's just keep sales the same, put the two together, you get 62, which actually is a relatively logical way to do it.
But it's
not what they did, but it's a logical dissent.
But it's also a little bit of a tightening bias.
Yeah, potentially.
So you
certainly
talk about, because they talk about easing monetary policy, but at the same time, they're actually reducing the size of the balance sheet by way of quantitative tightening.
Yes.
So you've got this push-pull effect, which you could argue is exerting upward pressure on yields all by itself.
Oh, I don't think there's any argument about that. I think it's pretty much guaranteed that it's exerting upward pressure on the long end of the curve. I mean, certainly the active sales that they've been conducting, and They have now trimmed that, so long end sales are only going to be 20% of what they sell over the next calendar year. But I think, fundamentally we're in a market where nobody is overly keen to be buying gilts. The last thing we need is an even greater supply of long duration UK government debt. The Bank of England have been throwing that out into the market. Of course, that's going to put a premium onto the 10-year and 20-year and 30-year gilt yield.
Yeah, recently I think there was a debt auction which was 14 times oversubscribed, so it suggests there is an appetite there.
If the yield's high enough.
Yeah, I guess so.
It's just a case of, and that was also a 10-year syndication, which is going to be taken down a lot better. But yeah, I think it's just a question of, if the yield is there, people will buy. I'm looking this morning and, well, the spread on a 10-year gilt over a 10-year treasury is about 70 basis points, 60 basis points. So, and that is basically a risk of UK fiscal shenanigans kicking off once more, and that's purely reflective of that. But the yield premium is there if people want it.
Which brings us on to the public sector borrowing. I think it's quite a neat segue, that, because ultimately debt interest was a good proportion of the fact that we came in at £18 billion, which was nearly £6 billion over estimate. I mean, that's a chunky miss.
Yeah, and again, it's very much sort of more of the same because, not only that, but you've also had, I think in the first 5 months of the year, it's the highest borrowing figure we've ever had outside of the pandemic year, which was 2020, which of course is a bit of a special case. It's unsustainable, quite clearly unsustainable. Markets have rightly reacted adversely to that in early trade this morning. But it just brings us back to that sort of age-old question of what are we going to do about it? Further tax increases are not the answer. Spending cuts are the answer, but they can't get through Parliament. It's the same argument and debate that you and I and every man and his dog on the sell side have been having for the last 6, if not 12 months. And there just doesn't seem to be any desire within the Treasury or within Whitehall more broadly to bite the bullet and say, we cannot spend at the level we're spending and increase spending at the rate that we're doing it forevermore. We need to have a reckoning. We need to tighten our belts. We need to spend within our means because, things are just ultimately spiraling out of control. And this fiscal black hole seems to get deeper by the minute. Yeah,
I mean, a borrowing figure fiscal year to date has been $83.8 billion. The OBR estimated a figure over 10 billion less than that.
Well, I've got an envelope over here. What I estimate on the back of that is going to be more accurate than the OBR, I think.
So obviously, this budget headroom.
It doesn't exist.
It doesn't exist. I mean, the media talk about Rachel Reeves's fiscal headroom. Well, if you basically take the OBR estimate, which I think was £72.9 billion, and you look at what they've actually spent, which is £83.8 billion, even by my crude maths, that's more than £10 billion.
Yeah.
Gone. Okay.
So that takes you back to zero because you had 9.9 billion. So that takes you back to zero straight away. You've then got, there were other earlier reports this week that the OBR are going to downgrade their productivity growth expectations for the UK. So for years, the OBR have been saying productivity is going to grow 1.1% a year in the UK. We all know that that's nonsense, but they've kept it as an assumption in their forecast. This might be the year they change that. For every 0.1% that you edit or downwardly revise that assumption, it adds about a £10 billion cost onto the budget. So they're going to probably nudge it down by 0.2%. You're now 20 billion in the hole. That's 30 billion you've got to find. That is before you even account for any of the other changes in the forecast in terms of potentially slower growth, a different market profile in terms of interest rates. I would say 30 billion in terms of revenue raises and spending cuts is probably a conservative estimate at this point.
And it needs to be spending cuts. I mean, I was looking at the employment trends in the private sector, and employment trends in the private sector are for fewer jobs to be available in the next 12 months. And I'll talk a little bit about that when I talk about next. But if you look at the public sector, 6.2 million people are on the public payroll. Now, I have no objection to people, public sector jobs growing if public services are getting better. But we've had 75,000 new people employed in the public sector over the last 12 months.
Which is insane.
Now, if you factor in the number of private sector job losses over the same period, that is not sustainable, because the private sector taxes need to pay for those public sector roles.
Exactly.
And we're not getting GDP growth. The economy is stagnating. And ultimately, this government, which may have a huge majority, is factional.
Yeah, 100%.
They can't even pass water, let alone legislation. So, for me, the welfare reforms that they tried to pass earlier this year, I think, were emblematic of the problem. And until such times as the bond market imposes some sort of discipline on them, then this budget is not going to solve any of the problems facing the UK economy.
No, absolutely.
Starmer and Reeves probably will remain in place because the alternative doesn't really bear thinking about. But I think within the next 12 months, change could well be forced upon them by the bond market.
I think you're absolutely right. And, I was, again, talking about this the other day. We mentioned earlier on the BOE tweaking their active sales, the debt management office. They swapped out a 30-year auction for one at the front end in December. That's due to take place. These are all sort of sticking plasters, effectively. They buy the government a bit of time. They relieve a little bit of pressure in the gilt market to allow the government time to restore fiscal stability. The problem is they've been bought that time and they're not using it. So I still think gilt yields are heading higher. I still think, as you rightly say, there is going to be this sort of fiscal reckoning at some point. And there needs to be a realization that, the reason the economy isn't growing is because businesses and consumers alike are suffocating under the highest tax burden that we've had since the war. It's simply not sustainable. That you are taking as much money out of private enterprise and consumers, and you and I earning salaries, whatever, as you possibly can. You cannot get blood out of a stone, ultimately. There is another side to the ledger, which is what your outgoings are. That's the side you need to look at. That's where you need to make some significant cuts. And unless you do that, then the market is going to continue to effectively have no faith in the Treasury. And you mentioned the welfare reforms. The thing that sort of went under the radar a bit at the time, because it was also chaotic, was that they weren't actually spending cuts. That was a bill to slow the pace of increase in welfare spending. And they couldn't even get that through. So how are they going to try convince their MPs to cut spending? I recall at the time there was a Labour MP walking around the floor of the Commons. We never found out who it was, who went, well, it's only a few billion. Why does that mean we have to raise taxes? I mean, that just sums it up, doesn't it?
That feeds into the discussion I think we were having at the Good Money Guide conference on Wednesday, that financial literacy here in the UK is not particularly high and really does need to be improved. And I think that is really borne out by an awful lot of the comments that we hear from our supposedly responsible elected MPs. And I think this government reminds me to a certain extent of this Monty Python sketch in The Black Knight. With every sort of warning from the markets, they say, "Oh no, 'tis but a scratch, 'tis but a scratch," as the arm falls off, and then, the leg falls off. At some point, they're going to have to start paying attention. We're not there yet. We may not be there for quite some time, but certainly I think there needs to be acknowledgement on the part of the government of the problems that the UK economy faces. And until they acknowledge those problems, it's going to be very difficult to convince businesses and investors to invest in the UK. And it was interesting this morning, cash ISA use went up massively.
Oh, where did you get that statistic from, Mr. Hewson?
Yes, I wonder. I think you might have tweeted something about that, and that's actually, and when you dig a little bit deeper into it, that's before all of this talk that Rachel Reeves was going to basically abolish the cash ISA. So that doesn't include the numbers for that particular period of time.
No, you're right. And I think it was a shocking number. I think it was, I haven't got it in front of me now, I think it was just over 100 billion in total was put into ISAs over the last year. And 2/3 of it went into a cash ISA. Now, I seem to have caused a bit of outrage in some corners of the internet for even pointing this out. I'm sort of persona non grata now, I think. But there are valid reasons for having a cash ISA. I've got no issue with it whatsoever.
I've got one.
If you are,
I've got one.
if you want to hold emergency savings, or if you're buying a house and you just need to have a deposit there for a year while you go and find the right place, or maybe you're an 81-year-old who is just wanting cash and doesn't have a high risk appetite. There is a time and a place for those products. The problem is if you are a 28-year-old, let's just take this as an example, and you have 30, 40 years until you retire, and you have a relatively high risk appetite. Even if you have a relatively low risk, you should be investing in the market. But the problem is there is no. And obviously none of this is advice, but there isn't a high enough degree of financial literacy within the country, and there's not a culture of investing as you get, in the US, for example, where you've been recently. That doesn't exist. It's almost a case of, well, the stock market, that's a casino. I could go in and lose everything. Well, yeah, there is a downside risk, but also
if you
the
put all your eggs in one basket, yes.
Exactly. You diversify your portfolio, and also over time, the equity market is a fantastic compounding and growth machine, whether that be the UK, US, wherever.
Well, there's this rule of thumb that I used in the debate that we had, or the discussion that we had on Wednesday. And I said, look, if you had £10,000 in 2020 and you put it in cash, okay, in real terms now, you would be worse off.
Yeah, I'm sure you would. Now, obviously, we've had very high inflation, but you would definitely be worse off.
But if you put it in the FTSE 100, FTSE 100 is up 50% since 2020. And I know that's a very crude comparison, and that's only over 5 years. But you invest for the long term, you save for the long term, but you also save for the short term if you can.
Yeah.
And I think that's the point that we're trying to make. We're not saying that saving in cash is bad. We're not saying that at all. Everybody needs to do that. But they also need to have a long-term plan. To basically mitigate the effects of inflation. And ultimately, if you've done that and have done that over the course of the last 10, 15, 20 years, even since the financial crisis, since 2000, you saw a big sell-off in 2007, 2008, 2009. But you would have ridden through that and you would be out the other side now. That's the key point. Anyway, we're digressing.
We've gone off onto a tangent.
We've gone off a tangent.
An important tangent.
It needs to be said. That. But ultimately, let's move away from that. Basically, bottom line, got the budget on November the 26th, and Rachel Reeves has a mountain to climb because ultimately, any tax rises that she implements will be subject to the law of diminishing returns, as the last set of tax rises were in October last year.
And as the next set will be when they inevitably get delivered, probably in about 6 months' time.
Yeah, and businesses will then adjust accordingly, cut hiring, cut costs, and
exactly that.
They will have low profits. Anyway, next results. Decent set of numbers, but for the first time in a while, they didn't upgrade their guidance. And that prompted the shares to fall quite sharply initially. They were down as much as 6%, I think, but they've recovered some of that. The shares bounced off the 200-day moving average, which was the long-term trend higher. They have been trending lower since May. 10.3% increase in first half group sales and a 13.4% increase in profit after tax of 387 million, with full year guidance left unchanged. And I think people were a little bit disappointed by that. I'm not really sure why. I was more or less expecting it given the outlook.
Well, and also, I mean, with Next, we say this every time they report, there is going to come a time where they don't upgrade their guidance. This was the time, but they've already upgraded it 3 times this year. There is a limit, and 4 times last year. There is a limit to the number of upgrades that you can actually, delivered in that guidance to market. And also, as you say, in an environment where downside risks to the economy, particularly in terms of consumer spending and sentiment, are plentiful, it would be incredible, frankly, if they did feel comfortable to upgrade things again.
I mean, I was looking at the overall numbers for H1 total next sales, record £3 billion for for the first half. I mean,
which isn't too shabby, is it?
That's a very strong number. And most of that growth was online. It was in their online operation. I mean, the stores still had a fairly decent half, but, you know, they were overshadowed by the online. And, you know, Simon Wolfson, Lord Wolfson, whatever he wants to be called, main risks were that the long-term outlook for the UK is not favourable. Healthy control of its cost base and improvements in its international business are helping to prove a fairly decent offset. But one thing struck me, I think, when I was reading through the report, were the next comments on employment trends within the business, as you know, which is almost being used as a proxy for the wider economy.
Which we may as well, because the actual data is so useless. So
vacancies are down 35%. In Next, in the operation there, and applications are up 76%.
Which says a lot.
Which says a lot, because essentially what it's saying is that employment conditions are getting more challenging. They're getting more vacancies, but they haven't got anywhere. They've got less vacancies and they've got more applicants.
Yeah, which suggests that the labour market is getting much, much looser.
Yeah, and obviously costs are also a challenge. The national living wage costs and CPI graph was quite sobering. When you actually look at CPI inflation since 2015, up 38%, national living wage is up 88%, and the cost of part-time employment, including national insurance, 16-hour week contract, up 102% in the last 10 years. Increasing cost of employment, part-time workers up 102%.
And of course, the thing you've got to remember, and that's frankly staggering, but of course, and this isn't unique to Next, but it's common, a lot of the retailers, and it will also be the case in the hospitality sector, in those sectors that rely quite heavily on lower income workers, proportionately, this has a much bigger impact on their businesses than it does on others that have a much wider spread across the sort of income spectrum. Particularly when it comes to things like raising the minimum wage or the living wage or whatever it's called these days. But yeah, I mean, again, it just speaks to the basically anti-business environment that seems to be being created at the moment.
Yeah, I mean, as I say, that's on page 22 and 23 of the PDF. Part 3, focus on UK employment for Next. And, those are some fairly sobering stats.
Yeah, and of course, Next aren't going to be the only ones. Yeah, that's every single business in the country is going to feel that.
So that was really the sort of the standout result from the UK this week, Next results. And I think they tell us an awful lot about the state of the UK economy, consumer trends. Obviously, we had the GfK consumer confidence numbers out this morning, and they were worse than expected. So
well, are you surprised?
And yet UK retail sales are up for 3 months in a row, apparently. So I wonder if they'll get I wonder if that'll get revised away. Anyway,
the July print was revised down this morning. I wouldn't be surprised if the August one is revised down again next month. I mean, it's a bit shambolic at the moment, isn't it, to say the least?
Yeah, retail sales month on month, 0.5%. 0.5% in July, 0.4% in June, and obviously May was down -1.2. Okay, so let's move on to FedEx. Decent rebound in the after hours for FedEx shares. The turnaround story appears to be continuing apace. Q1 beat forecasts. Q1 revenue at $22.24 billion. Profits jumped to $912 million, up from $892 a year earlier. Obviously, international trade pressures, $1 billion. Yeah. I mentioned that earlier. But stronger domestic business. So again, the US economy may well be slowing, but domestically it's still contributing to growth in the US economy, albeit on a slightly weaker basis than was the case a year ago. And yet FedEx is actually doing better profit-wise than it was a year ago.
And again, your point on the domestic US economy speaks to the retail sales data that we had out of the States earlier in the week. Headline sales rising 0.6%. I think the core metrics were up 0.7%. That kind of adage of never bet against the US consumer ringing true again. And, yes, momentum may be waning. Yes, there are clearly challenges, whether it be coming from the labour market or the main one being hurdles in terms of trade. But fundamentally, I think under the surface, the US economy is still bubbling away quite well.
Yeah, it's ticking over. I would say it's ticking over. Domestic parcel volumes up 4%, helped by the duty exemption on goods valued under $800. I mean, I think that's
which is going away.
Which is going away. So, maybe that's a headwind going forward. Maybe Trump needs to rethink that.
Yeah, well, I think he probably does, to be honest. Although that did come to an end at the end of August, so we've had, a month or so of that now. He's speaking to President Xi today, so let's see what they chat about, but I wouldn't hold your breath for anything to change on that front.
Okay, Olive Garden, Darden Restaurants. Big fall in the share price there, fell below this 200-day moving average. And yet, on the face of it, I'm not going to make the pun. I'm struggling to understand why, because total sales up 10.4%, $3 billion. Obviously, part of that was helped by the acquisition of Tex-Mex restaurants. Profits slightly below expectations, but they're still a lot higher than they were a year ago. And on same-store basis, Olive Garden up, Longhorn up, and guidance was also revised slightly higher as well. And yet the share price has dropped to its lowest level since March. So... I suppose some investors are difficult to please.
Well, indeed. Would you like to know who's buying the dip in Darden Restaurants?
Well, I think I bought a few. Who is buying the dip, sir?
Certain bloke called Jim Cramer.
Oh, my God. Okay. Yours.
He was very, very bullish on the stock yesterday on CNBC. For those who are unaware, Jim Cramer is a long-time financial market participant, commentator, reporter, whatever he is these days. And he has a rather unfortunate knack of being a contrarian indicator without trying to. He seems to turn bullish on something and all of a sudden it acts as a bit of a jinx. So...
Have they still got that? Have they still got that inverse Cramer ETF out there? Is that still running?
I think that is still kicking around somewhere. Yeah.
Yeah. He famously once said, "Yeah, Bear Stearns will be okay," the day before it went bust. Or it was certainly a matter of,
and it's only ever gone downhill from there. I think.
Yeah, it has really. So he's got a bit of a reputation. Sometimes it's a little bit unfair, but he doesn't help himself. Anyway. No. Let's move on to next week. Fairly light docket. We've got flash PMIs out of the UK. Services has actually been fairly resilient in the past few months. 54.2 in August and the highest level since April 2024. So a little bit of resurgence in optimism when it comes to new orders, perhaps, or maybe the fact that the trade deals that have been crafted between the UK and the US have allayed some concerns, so maybe you're getting a little bit of a rebound there. But unemployment, but employment trends are still not great when it comes to the PMIs. What do you think, Michael?
No. Well, the thing that and I think this has been a sort of characteristic of this economic cycle, actually, not just in the UK but globally, is where what we see in the sentiment data, or the soft data as we would call it, like the PMI surveys, doesn't really seem to have translated into the hard data, things like retail sales and GDP. You look at consumer sentiment, for example, whether it be here or in the United States, it's fallen off a cliff over the last 6 months. Yet consumer spending has remained relatively resilient. So consumers aren't feeling particularly optimistic, but they're still going out and spending in their droves. Almost the opposite is true when it comes to the PMI metrics. As you said, we had a 12-month high on the services figure last time out. That is set to pull back a bit to 53.4 this time out, but that would still imply a solid pace of expansion. But then you get the hard data, and we're just sort of hovering a rounding error away from stagnation every month. So I would not be putting especially much weight on the figure itself, where that actually comes in. I think the real value in these surveys, if there is any at this point, is when you dig into the data. And as you say, what are the anecdotal comments in terms of price pressures, in terms of employment, the order pipeline, that kind of thing. That's where the value is. I'm not convinced from a market perspective or from a policy perspective that the actual PMI itself matters, but particularly much.
I mean, I think it's more pertinent or relevant. I think you'll gain more information by looking at the reports of UK retailers. So companies like Next, companies like Kingfisher, companies like JD Sports, Tesco's, Sainsbury's.
The big retailers.
And the Kantar surveys. They'll give you a much better indication of how the UK consumer feels and where they're spending their money.
Yeah, absolutely.
Which sort of brings me on because, we could talk about US personal spending in August, US PCE. I mean, I certainly did a bit of personal spending in August in the US. So
I don't know whether any of our listeners have realised, because it's only been mentioned 200 times, but Michael Hewson was in the US for a brief period.
Helping
over the last
prop up the
month
Olive Garden share price and the Cheesecake Factory share price and Denny's share price. Anyway, Kingfisher. It's not been a great quarter for Kingfisher share price. And for those of you who don't know, and I'm going to say it, they own B&Q. So, DIY, do it yourself. And that's what I would say when it comes to basically analysing UK economic data. Do it yourself.
Yeah, basically, yeah.
The share price has fallen to its lowest level in 4 months this month. But that was largely on the back of a downgrade from Deutsche Bank. Along with it downgraded Kingfisher, Associated British Foods, who own Primark, over concerns that I think that a slowdown in UK consumer spending would impact its numbers. Why it didn't include JD Sports in that, I really don't know, because obviously they are reporting next week their first half numbers, as are Kingfisher. But it'll be interesting to see whether or not the French business has improved. I mean, the French business still looks like a dog's breakfast. Has done for years. Has done for years. It's almost like a loss leader. The UK business, on the other hand, has been holding up much better. Screwfix sales is a very, very strong business. Continues to do reasonably well. What will this tell us about not only the UK economy but the French economy as well?
Yeah, and I think that these earnings will tell us quite a lot, because obviously if you are embarking on a big home improvement project or whatever it may be, you're only going to do that if you've got a decent amount of confidence in what the outlook looks like 6, 12, 18 months down the line. And if the earnings do come in soft, or if the guidance comes in soft, then I think that is a little bit of a sort of red flag as to, well, actually, hang on a second, maybe consumers are starting to batten down the hatches a little bit more.
I think the pessimism and the recent share price weakness may well be overdone in respect to Kingfisher. Having said that, I think we need to know whether or not they still think they're going to meet their full year guidance. They did when they reported at the end of Q1, and that guidance is for adjusted profits before tax at between £480 million and £540 million. So they've had to absorb higher employment costs on both sides of the channel. Be interesting to see whether or not the picture around that has changed, and whether the relative optimism that we saw at the end of Q1 has been maintained as we head into the second half of the year. JD Sports, right, slightly different story with JD Sports, because obviously they've got a very big US operation.
Yes.
Obviously there was concern about their exposure to China and Vietnam in terms of that's where they get most of their product from. Seen a rebound from recent lows. The share price has rebounded quite strongly from those April lows. Come back from about 100p. It's around about 90p now. The numbers themselves, expectations for profits this year are currently in the area of £890 million. It'd be interesting to see if they change that. Not really much else to say there. Sales growth in line with expectations. US trading was particularly weak in the first quarter. Be interested to see if that picked up in the second quarter. I think that's really all I've got to say on that, unless you've got anything to add.
No, I was going to say I don't think there's much else to add on that we haven't already covered. I think the only thing that participants will be wanting to focus on is that guidance. Is the current number realistic, or does that get revised? The other thing with them, of course, is that they've kind of quite heavily tilted their expectations towards the second half of the year, given what you just mentioned in terms of H1. So, I think it would be very important to see whether they're still as bullish on H2 as they were previously.
Yeah, if we're going to finish off with Raspberry Pi, the reason I'm mentioning Raspberry Pi is because it was one of the few IPOs that we had here in the UK in 2024. In fact, I think it was probably about the only one.
Say there aren't many to choose from.
Or one of the very successful ones. I mean, there has been some talk that we could see some IPOs this year. I think one of the IPOs that's being touted is SumUp. And those of you who basically go into any small retailers will know that SumUp are those small card machines.
Yeah.
So you go to the hairdressers, you get your hair cut. It's a SumUp machine, something like that.
Although the reports that we had, I think it was back in the last week, they are weighing up whether to do that in London or New York, and sadly, we don't know how that debate is going to end.
Yeah,
I hope it doesn't end that way. I hope they do. I hope they do list in London, but I can't imagine they will. Sadly.
So I mean, Raspberry Pi done very well. It's still well above its IPO listing price, but it's at the lows of the year at the moment. It's around 400p. It went as high as 775p. It's been on a slow downward track since mid-May. It's around the lows, and it's pretty much been the lows of where it was for the past 12 months. So this 400p level is quite a big level for it. It'll be interesting to see whether or not it can actually rebound from those levels, but it does appear to me that demand is waning for these particular shares. So I think they need a really good set of numbers to inspire a rally back to the levels that we saw in May of around about 550p.
Yeah, I think I'd agree with you on that one. I mean, the shares, I'm just looking at the chart here, they've basically halved from where they were in January. And I think risk is very much, given as you say, the seeming waning appetite for the stock, I think risk is very much tilted to the downside in terms of any disappointment is going to be punished quite severely, you would expect.
And you could argue that Raspberry Pi is UK tech. So why is it not doing well?
Well, is there a demand for what they're doing, I suppose, is the question.
Yeah, I think that's the thing. I mean, but one of the reasons why the shares did so well towards the end of last year and the beginning of this year was because there were some reports of overseas buying of the shares, with US investment group SW Investment Management being touted around at the start of the year. That's all gone a bit quiet. I mean, is it
again
is it a
little
takeover
bit
target?
Concerning.
Is it a takeover target?
Well, it's a cheap London listed stock in a sector that is very, very hot. I mean, it's as much of a takeover target as anyone else. I mean, I think again, though, just going back to that, your point around that overseas interest, and it seems to, well, whether the interest is still there, we don't know, but certainly the chatter around it isn't there. That again just speaks to, I guess, waning appetite for the shares potentially.
I mean, this overseas interest,
they've got cold feet.
Yeah, I mean, this overseas interest came around when the share price was at 600p. So if they're interested at 600p, well,
be even more interested at 400. Yeah,
exactly. So anyway, so that's Raspberry Pi. JD Sports, Kingfisher next week. US PCE, US personal spending, UK flash PMI. So it's looking to be a fairly quiet week.
Oh, don't say you've just jinxed it. Thank you, Mr. Hewson. If next week kicks off, I'm coming around to knock on your door and blame you. This week's been tiring enough. I don't need another one like that.
Yeah, well. After hearing your puns on the panel, like the Good Money Guide the other day, I think you deserve it. So,
well, to be fair, you were the only one who noticed. So,
well, yeah, that's because I'm used to you,
or tired of me. One or the other.
One or the other. Anyway, on that bombshell, I think we'll wrap up the podcast for this week, and you can join us same time, same place next week. Thanks for joining us, and have a great weekend.
Bye for now.